Hello, my name is Vasudevan. Today we will talk about stock valuation. In the last chapter we talked about bond valuation, and today we will talk about valuing different types of stocks. So what are some of the key things we want to study? We will talk about how stock prices depend on future dividends and dividend growth. So basically here we are saying that the value of a stock is the present value of the future dividends. And we will talk about the dividend growth formula. We will also talk about how the stock market works and how stock prices are quoted and how corporate directors are elected. So these are the key things we want to talk about. Okay? So as an investor, let's say you want to buy a stock. Okay, let's say you want to buy shares of Apple or shares of Home Depot or any other company. There are two ways you can get the money. The first is the company might pay a dividend. Now here, you have to understand that not all stocks pay dividends. So as an example, I don't think Google pays a dividend. Facebook doesn't pay a dividend. LinkedIn doesn't pay a dividend. Netflix doesn't pay a dividend, and so on. Okay? So you can also sell your shares either to another investor in the market or back to the company. So the second way you can make profits perhaps is you buy the stock today at $10. You're hoping that you can sell it for $11 or $12. So that is the profit you make because of the increase in the price. And if you look at the two sources of income, the return you get because of the dividends, that is referred to as the dividend yield. And the second part, the return you get because of the increase in the price, that is referred to as the capital gains. Now, why do we care about this? The main reason why we care about this is because the way you are taxed is different depending upon the income you receive. Okay? As with bonds, the price of the stock is the present value of those expected cash flows. So basically here we are saying that in chapter 6 we said the value of an investment is the present value of the future cash flows. And here the future cash flows we are assuming, we're going to assume is all the dividends. Okay, we'll talk about why we make those assumptions. So whenever I talk about this chapter, typically in class, I talk about a stock called Altria. And what is Altria? Altria is a company that is in the cigarette business. So till recently, they had two divisions. One was the cigarette division, that is Philip Morris. The other was they were also in the food business. So companies like Kraft Cheese belong to Altria. Now, in recent times, what they did was they split up the company in two parts. Altria is the parent company. They own the cigarette business, and the other part was given to shareholders in the form of a spin-off. Okay? And basically, the reason why I talk about Altria is because that is a stock which has one of the biggest dividend payments in the US. And it's a very to illustrate this. It's a very good example. Okay, so as an example, last year, so in October 2014, the price was $46. Today, the price is approximately $56.81. And during the year, the stock paid $2.21 in dividends. So basically here we are saying that when you buy the stock, if you bought the stock last year, there are two ways you could get income. The first was you got $2.20 because of the dividends, and the second was you got an increase in price. So you paid 46, you're going to sell it for 56.81. So basically here you made $10.81 because of the increase in the price. So when you talk about the return of the stock, that has two parts. One is the dividend yield. So that is the dividend you receive divided by the share price when you bought the stock. And the second is the price at which you perhaps can sell the stock today, which is $56.81, minus the purchase price, which is $46, divided by the original price. So what we find here is that you made 4.78%, almost 5% because of the dividends, and you made $10.85, almost 24% because of the increase in the price. So what I find here is that this stock again had a return of 28.3%. I don't know how many years I've been following the stock, but maybe around 10 years, there have not been too many down years for the stock. And as I told you, perhaps the most interesting thing about the stock is the high dividend that it pays. Okay? So now we want to talk about perhaps a model referred to as the dividend growth model, and we want to talk about how it works. So suppose you're thinking of purchasing the stock of Moore Oil, and you expect to pay a $2 dividend in 1 year, and you believe that you can sell the stock for 14. If you require a 20% return on investments of this risk, what is the maximum that you'll be willing to pay? So basically here what we are saying is that if you buy the stock today, there are two things you can get. You can get a $2 dividend in 1 year, and you hope to sell the stock for $14 in 1 year. So how much is the worth of stock today? We are saying that the value of the stock or the price of the stock today is the present value of the future cash flows, and that is the $2 dividend plus the $14 you hope to sell the stock for. So overall, you can receive $60, and the present value of that, using an interest rate of 20%, that is going to be $13.33. So what we are saying here is that if you are able to buy the stock today for $13.33, you get a $2 dividend and you can sell the stock for $14, you're going to have a return of 20%. Okay? Now suppose you want to look for 2 years. In addition to the dividend in 1 year, you expect a dividend of $2.10 in 2 years and a stock price of $14.70 at the end of the year. How much would you be willing to sell? How much would you be willing to pay? So what we find here is that there are two dividends you get. The first is the dividend in $2 in the first year, and the second is the $2.10 plus the $14.70 in year 2. So that is why the first dividend we're going to find the present value using the 1 year, and the second one, the $14.70 plus $2.10, we're going to find the present value using 2 years. And the price is exactly the same. And one thing you have to understand here is that this is a textbook, and we have a textbook example, and what we are assuming here is that the stock is growing the dividend at 5% every year. So $2 for the first dividend, the next one is $2.10, and so on. And the price is going to be $13.33. Finally, what if you decide to hold the stock for 3 years? In addition to the dividends at the end of years 1 and 2, you expect to receive a dividend of $2.21 at the end of year 3, and the stock price is expected to be $15.435. Now, how much would you be willing to pay? So basically here, we are assuming that the first year is $2, the second year is $2.10, and the third year is going to be $2.21. So again, we are assuming growth at 5%, and the price of stock is going to be $13.33. So basically here, what we are saying is that we are assuming that the stock is growing at 5% every year, or the dividends are growing at 5% every year, and the price of stock is the present value of all the future dividends. So basically, to illustrate what is referred to as the dividend growth formula or the dividend growth model, we're going to look at 3 cases. The first is we are going to assume that there is a constant dividend. So what we are assuming here is that, let's say the stock pays a $2 dividend forever. Okay. So where do we use this? We basically use this formula, price preferred stock. And what does this do? This is basically like finding the present value of a perpetuity. The second one is a constant dividend. So that is similar to what we just talked about. We assume that it grew at 5%. So whatever can be the growth rate, we're going to assume that it's going to grow at a constant growth rate forever. And the third one, perhaps, is the most normal case. We are assuming that the stock is going to grow at a very high growth, perhaps for a few years, and then it slows down. So basically here, what we are assuming is that the dividend growth is not consistent initially, but settles down to constant growth eventually. Okay. So let's look at the 3 cases. The first one is zero growth. That is the easiest case. If dividends are expected at regular intervals forever, it's a perpetuity, and the present value of future dividends can be found using the perpetuity formula. So the price of the stock today is the dividend divided by the required rate of return. So as an example, the stock is expected to pay 50 cents every quarter, and the required return is 10% with quarterly compounding. What is the price? So basically here, one thing you want to be careful about is that you always want to make sure you take everything in the annual terms. So the dividend is 50 cents every quarter. It's going to be $2 every year, and the required return is 10%. So what is the price? The price is going to be the annual dividend, which is $2, divided by 10%, which is the required rate of return. That gives you the $20. The dividend growth formula, dividends are expected to grow at a constant percentage per year. So we are assuming that it grows, let's say, at 5% or 10% every year. So when that happens, what we are saying here is that the price of stock is given by D naught times 1 plus G divided by R minus G. So here D naught stands for the last dividend. So what we are assuming here is that we are at time t equals 0, and at time t equals 0 the dividend D naught has been paid out. So whenever the question says the stock just paid a dividend or the last dividend was so much, it always stands for D naught. G is the growth rate of the firm, R is the required rate of return. Now D1 stands for the next dividend. So whenever the question says the stock is expected to pay, or the stock is forecasted to pay, or the stock will pay, that stands for D1. So what we are saying here is that D naught times 1 plus G. So as an example, D naught is $2. The dividend growth rate is 5%. Then D1 is going to be $2.10. So the numerator D naught times 1 plus G is the same as D1. So suppose Big D Incorporated just paid a dividend of 50 cents. It is expected to increase the dividend by 2% per year. If the market requires a return of 15% on assets of this risk, how much should the stock be selling for? So as we can see here, the question says just paid, and just paid means D naught. Okay. So once we have that, we can use the dividend growth formula, D naught times 1 plus G divided by R minus G. That gives you $3.92. Suppose TB Pirates is expected to pay a $2 dividend in 1 year. The dividend is expected to grow at 5% and the required return is 20%. What is the price? So here P naught stands for the next dividend, which is D1 times R minus G. That gives you 1333. So you have to be careful. You want to make sure you look at the wording of the question. Does it say the last dividend, or does it say expected, or the next dividend? And last dividend is D naught always. The next one is D1. Now here what we are saying is that stock price sensitivity to dividend growth. So as an example, if you use the formula, the dividend is $2, the required rate of return is 20%. So we are keeping both these numbers the same. So if the growth rate is 10%, then what is the price? So D1 is $2 divided by 0.2 minus 0.1. That gives you a price of $20. At a growth rate of 15%, the price would be D1 is 2 divided by 0.2 minus 0.15. So 20 divided by 0.05, that gives you a price of $40. So the price almost doubles. At a growth rate of let's say 20%, we get a nonsensical answer. The price would be infinite. Okay. So basically here what we are trying to illustrate is that whenever you look at a company such as Facebook or Google or any other company that has a high growth opportunity, where basically there we are willing to pay a very high price when compared to a more mature firm such as Walmart, which has been out there for a long time, or a company such as Microsoft. Although Microsoft is now trying to start growing once again by getting into new lines of business, coming up with new products, and so on. Okay. Now the second one is stock price sensitivity to required return R. So again, if you use the same formula, at a growth rate of 5%, the dividend is $2 and the growth rate is at a required return of let's say 10%, the price would be 2 divided by 0.1 minus 0.05. That gives you $40. At a growth rate of, I think this is wrong because here we have required return and here we have the growth rate. It should have been the required return should be on the x-axis. So at a required return of 25%, the stock price becomes 2 divided by 0.2, 2 divided by 0.25 minus 0.05, that gives you 2 divided by 0.2, $10. So basically here what we are saying is that as the required rate of return goes up, the price of stock will go down. So usually when does the required rate of return go up? So basically here what we are saying is that usually as the stock gets riskier, as there is bad news about the company, this could be regarding earnings, regarding perhaps some action going to be taken by, let's say, the government and so on, we can expect the stock price to go down. So as an example, right now, one of the companies that has been in the news is Volkswagen. And the reason why Volkswagen is in the news is because people have found out that, especially for the diesel vehicles made by Volkswagen, they have been cheating. So they have been lying as far as the emissions have been concerned. So they have been saying that those diesel engines do not make much pollution, while in fact they are polluting substantially. So there's a very high chance that the US government, the European governments and so on will sue Volkswagen. So that's a high risk environment as far as the Volkswagen stock is concerned. So that's one of the reasons why the stock plunged as soon as the news came out that Volkswagen had done these things. So the reason why the stock price is plunging is because the market realized that there is going to be a lot of lawsuits, there is going to be a lot of risk as far as the Volkswagen stock is concerned. Now, let's look at another example. Gordon Growth Company is expected to pay a dividend of $4 next period, and dividends are expected to grow at 6% per year. The required return is 16%. So if you look at this question, what it says here is that it is expected. So whenever it is expected, that stands for D1. And given that the price is going to be 4 divided by 0.16, which is the required rate of return, minus 0.06, that is the growth rate. So that gives you $40. Okay. What is the price expected to be in year 4? So if you look at year 4, essentially what we are doing is that we are going back to the same formula we talked about. Okay. The same formula we talked about, and we are essentially fast forwarding to year 4. So I just want to put this side by side. Okay. So if you compare this, we are taking P0 is equal to D1 divided by R minus G. Now here, instead of P0, we have P4. So we are basically adding 0 plus 4. And to the right hand side, instead of D0, we are taking D4. So these are the two things we make adjustments. We are basically moving forward to 4 years. So earlier we talked about P0. P0 is D1 and P4 stands for D4 times 1 plus G. So in both cases we are taking the next dividend. Okay. So P4 is actually D5 divided by R minus G. Now what is the implied return given by the change in price during the 4-year period? So if you look at the change in price, we said the price initially was $40. The price in year 4 is 50/50, and we want to find out the required rate of return, or that is the interest rate. So the interest rate is going to be 6%. Okay. Now we're going to talk about the non-constant growth problem statement. And as I told you initially, I think we're going to look at 3 examples. One is the constant growth. The second one is no growth. And the third one is the non-constant growth. So for all the 3 examples, this is the most difficult. So you want to take some time, look at this. You also want to go back to my courses and look at the examples I have posted under this talk folder. Okay? Because there's a very high chance you get something like this in the exam. Suppose a firm is expected to increase dividends by 20% in 1 year and by 15% in 2 years. After that, dividends will increase at a rate of 5% per year indefinitely. The last dividend was $1 and the required return is 20%. What is the price of this stock? So what that means here is that you are at time t equals 0. In the first year, the dividend goes up by 20%. In the second year, it increases by 15%. After that, dividends will increase at a rate of 5% per year indefinitely. If the last dividend was $1 and the required return is 20%, what is the price of this stock? So if you look at the numbers, we are at time t equals 0. The dividend D1 is going to be 120. The dividend in year 2 is going to increase by 15% to 138. The dividend in year 3 is going to be 1.449. Now if you go back to the wording of the question, basically the question says that after that the dividends will increase at a 5% per year indefinitely. So what that means is that whenever you see something like this saying that dividends will increase at a constant rate forever, it basically tells you that you can apply the constant growth formula at that point. So essentially here, after year 2, it starts growing at a constant rate. So starting from year 3, it starts growing at a constant rate, which basically means that you can find the price in year 2, which is given by the price in year 3 divided by R minus G. So that is 1.44 divided by 0.2 minus 0.05. That gives you 966. Okay, and the price in stock today, that is going to be the dividend in year 2, which is 120, plus the dividend in the dividend in year 1, which is 120, plus the dividend in year 2, plus the price in year 2. So one thing you want to be careful about is that when you are using the financial calculator or Excel, you want to make sure that in year 2 there are two cash flows, which is the 138 plus the 966. You want to make sure you add them together. Okay? So using the dividend growth formula to find R. So basically here what we are saying is that the price in stock is given by D naught times 1 plus the growth rate divided by R minus G, or that is given by D1, which is the dividend next dividend, divided by R minus G. So how do you find out the required rate of return? The required rate of return is given by D1, which is the next dividend, divided by the share price plus the growth rate. Okay, that's the first thing we did when we talked about this chapter. So let's look at an example. Suppose a firm stock is selling for $10.50. They just paid a $1 dividend, and dividends are expected to grow at 5% per year. What is the required rate of return? So here, if you buy the stock today, you're going to get a dividend of $1.05, which is 5% increase from the current dividend, plus you are expecting to sell the stock at a price which is 5% higher than today's price. So that is the growth rate. So the required rate of return is going to be the $1.05 in dividend divided by 1050 plus the 5% growth rate. So you're going to make 15%. Out of the 15%, 10% is the dividend yield and 5% is the capital gains. Okay. So you want to make sure you review these formulas here. It talks about a general formula. It talks about the case where the firm has a constant growth rate. It talks about the case where the firm has a supernormal growth rate. And finally, it talks about how you can find out the required rate of return. So these are the mathematical parts. Now we want to go and talk about some of the features of common stock. So the first thing is that when you buy a stock, you are one of the owners of the company. When you buy a bond, you are one of the lenders to the company. So that is the big difference between bonds and stocks. So what do you have? The first thing is that you have rights to the cash flows. So that typically comes to you in the form of dividend payment. And the second is that you also have the right to elect the board of directors and so on. Okay? So typically what we find is that, let's say you own 1 share or 100 shares in a company, typically you get something in the mail from the company. You get something in the mail from the company regarding the annual election, and usually, if you want, you can go for the annual meeting, or you can basically say that you're going to choose this person or this board of directors. That is referred to as proxy voting. And you also find that firms can have different types of shares. Okay? So what that means here is that if you look at a company like Netflix, or if you look at a company like Google, usually they have 2 types of shares. The first is the people who started the company, they have a set of shares called founder shares. What does that mean? Basically, this type of shares, when you buy that, you will not get any dividends, but you have voting rights. And the reason why they do that is because they started the company, they want to make sure that they don't lose control. And by having this founder shares, they have the voting rights and they are able to keep always the majority for themselves. Okay? And what are other rights? Shareholders typically share proportionally in declared dividends. They share proportionally in remaining assets during liquidation. So that's something we talked about in chapter 2. When you look at the balance sheet, what we said was common stock shareholders, they are residual owners. They get paid only after everybody else has been paid. They also have the preemptive right. So what that means is that in the US, it's not very common, but in Europe, basically you have what is referred to as a preemptive right. And what that means is that the first stock shot at new stock issue to maintain proportional ownership if desired. So most companies in Europe, if they want to raise more money, basically they say that current shareholders have the first opportunity to buy those shares. And if they don't want it, they basically offer it to the public. And what about dividends? Dividends are not a liability of the firm until a dividend has been declared by the board. So basically here we are saying that the firm has no obligation to have issued dividends. It is basically not an obligation. Consequently, a firm cannot go bankrupt for not declaring dividends. What about dividends and taxes? Dividend payments are not considered a business expense, therefore they are not tax deductible. So basically here what we are saying is that when a firm makes a coupon payment or when a firm makes an interest payment, those payments are tax deductible as far as the firm is concerned. But here when you talk about a dividend payment, the firm does not get any tax benefit. And the taxation of dividends received by individuals depends upon the holding period. So as an investor, when you receive the dividends, there's a high chance that you are liable for taxes. And dividends received by corporations have a minimum 70% exclusion from taxable income. So in the US, corporations can buy the shares of other companies, and typically what you find is that when they buy the shares of other company, 70% of the income they receive in the form of tax dividends is not taxable. So there is an advantage for corporations to invest in the shares of other companies that have high dividends. Now what about preferred stock? Stated dividend that must be paid before dividends can be paid to common stockholders. Dividends are not a liability to the firm, and preferred dividends can be deferred indefinitely. Most preferred dividends are cumulative. Any missed preferred dividends have to be paid before common dividends can be paid. So as a preferred stockholder, basically you are entitled to a dividend, but even if the company does not pay the dividend, you cannot do much about it. The only thing the company has to do is that they cannot give a dividend to their shareholders, common stockholders, unless they pay their preferred stockholders. And what you also find is that preferred stock generally does not carry voting rights. Okay. Now, what about the stock market? When you talk about the stock market, there are different types of stock markets. You have the dealer stock market, and you also have the brokers. So dealers are people who work on the exchange, while brokers are typically associated with the company. They are typically dealing with the customers. And in the case of the US, the biggest stock exchange is the New York Stock Exchange. It's also the biggest stock exchange in the world. And when you look at the members own seats on the exchange. You also have commission brokers. You have specialists who basically might deal perhaps in one company's stock or a few companies' stock, and their role is to provide liquidity to that stock, which basically means that they are always willing to take the other side whenever there is a trade. So if you want to buy a stock, if nobody else is willing to do that, the specialist will sell you the stock. And if you want to sell a stock, if nobody wants to buy it from you, the specialist can move forward to do the transaction. And then you have floor brokers and you have the floor traders. So in the case of a stock, typically you have a lot of activity taking place as far as the exchange is concerned. Now if you look at a NASDAQ, there is a big difference, and the big difference is that the NYSE is basically an auctions market, while the NASDAQ is a dealer market. So what that means here is that whenever you do a transaction, it always takes place with a dealer. And in practice, what you find here is that the dealer tends to be a computer, and you have three types of information. One is a median quote given by registered representatives. Then you have level 2, courts and brokers and dealers. And you have a level 3, you have only dealers. And when you look at the NASDAQ, typically the stocks tend to be smaller. They tend to be high growth stocks. And you also find a large portion of technology stocks. Okay, so I think I'm pretty much, as far as this chapter is concerned, this is it. I think it's an important chapter as far as the exam is concerned and so on. So you definitely want to make sure you go back, you're comfortable with the 3 different things we talked about as far as the valuation is concerned. And these are, we talked about the dividend growth formula. Basically, we said that the value of a stock is the present value of the dividends. And we talked about 3 different types of dividends can be paid. One is a constant dividend forever. That is like a perpetuity. The other is where you have a constant growth forever. And the third one is the supernormal growth. So the most difficult tends to be the supernormal growth. And you also want to, chances are you get some short questions based upon this. So basically there, you want to know what are the differences between bonds and stocks, and what are the different ways which you can, income you get when you buy a stock, and so on. Okay, thank you. Take care.